McGraw-Hill Ascent Audio presents Stop, Think, Invest, a behavioral finance framework for optimizing investment portfolios, by Michael Bailey. Narrated by Christopher Douyard. Publisher's Note: in this audio edition, you will hear references to figures present in the print and ebook formats of the book. Preface. In the teen comedy Better Off Dead, Johnny, an aggressive newspaper delivery boy, felt that his customer, the Myers family, shortchanged him. Throughout the 80s cult classic, Johnny desperately chased members of the Myers family around town on his dirt bike, demanding repeatedly to be paid $2. In the real world, emotional stock pickers desperately try to beat the market and chase returns, hoping repeatedly to be paid back for every penny of their investment. GE, an emotional roller coaster for investors. Investors in General Electric, GE, may have borrowed a page from Better Off Dead, as emotions clouded their judgment of the company's future prospects. In December 2015, GE's former CEO, Jeff Immelt, lit up the imaginations of investors with promises of jet engines, healthcare technology, and gas-fired power plants driving surging growth in the years ahead. Investors cheered, expecting GE's profits to soar from roughly $1.20 per share in 2015 to Immelt's audacious goal of $2 per share in 2018. Unfortunately, the initial ecstasy turned to agony and frustration as investors clung to the hope of $2 in future earnings despite a crumbling business and a stock price that was nosediving from the low 30s to the teens. How could this happen? After almost 2 years of telling investors everything was fine, GE finally fessed up in November 2017 and cut the $2 per share target nearly in half as business fundamentals collapsed, especially in the fossil fuel-based power segment. When all was said and done, GE actually earned an eye-watering 65 cents per share in 2018, and the GE share price fell into the single digits, figure P-1. The reality was a far cry from the CEO's initial enthusiasm about exciting long-term growth that could support GE's stock price. The rise and fall of GE in the decade after the great financial crisis of 2008 through 2009 was a rude awakening for many long-term shareholders. But why did investors ignore the warning signs at GE? Perhaps investors fell into a sense of complacency after years of getting comfortable with a trusted blue-chip stock that kept going up and paying attractive dividends. GE's board felt that Jeff Immelt and his immediate successor were better off fired amid the dismal company performance and stock price. Was this a simple story of bad luck in a competitive industry? Or can we see examples of emotional decision-making that can help us avoid the next GE in our portfolio? Many GE investors in the late 2010s drowned in a sea of bias and emotion. GE was a household name with a charismatic CEO, which may have fueled a sense of overconfidence that biased investors into believing the company's story, creating a collective blindness to risk and uncertainty. By trusting GE's management, many investors implicitly said, "I know GE, so I don't need to do extra work to figure out the risk." Making matters worse, the company's $2 earnings guidance may have propped up the stock and investor sentiment. Finally, investors anchored to GE's $30 stock price were unwilling to sell, cheered on by Wall Street analysts who also clung to buy ratings as the stock tumbled down a slippery slope. For GE, the self-destruction of an American icon had a string of behavioral warning signs that seem obvious in retrospect. However, many investors were unable to fully grasp the stock's potential risk when its price was still in the $30 in 2016. So what can professional investors learn from the chaos at GE? One approach would be to look for some of the warning signs that GE exhibited within our current stock holdings and as we research new investments. Going a step further, we can break up the entire investment process and look for potential GEs every step of the way. This is the goal of this book. Lowering the emotional cost of investing. Owning GE stock during the late 2010s may have felt like an emotional roller coaster. But why does money make us so emotional? Does making or losing money trigger an emotional response that makes us feel like winners or losers? When we mix money and emotions, we create a potent cocktail that can cloud or bias our ability to process facts and information as we make decisions. Emotions may lead us to make bad financial decisions, which have a real cost for professional investors, such as underperforming the market, losing clients, or failing to reach our long-term investment goals. Employees at GE who held big chunks of their retirement savings in GE stock may have experienced the severe emotional cost by holding the shares even as the business became a slow-moving train wreck. This book provides a framework so that investors can make better financial decisions and lower the emotional cost of investing. So where do investors begin as they try to make better financial decisions? Fortunately, there is a body of academic work that gives investors the tools to lower the emotional cost of investing. Unfortunately, the first step toward making better investment decisions may be an uncomfortable one. Professional and individual investors need to realize that they have to keep cool and actively push back against emotions and biases that seem to come naturally. When markets are failing and emotions are rising, as my colleague Michael Musio likes to say, stay frosty. In other words, stop what you're doing. Think hard about your next move. Then invest. At the core, this is the idea behind stop, think, invest. Now let's turn to some of the experts who created the ideas and concepts supporting a better way to invest. Daniel Kahneman, a psychologist and Nobel laureate who helped create a field of study called behavioral economics, says that in an altered emotional state, we believe our impressions and act on our desires. Real-world practitioners support Kahneman's views, as seen in the example of Howard Marks, a successful investor who uses behavioral economics at his firm, Oak Tree Capital. Marks believes that one of the biggest mistakes an investor can make is ignoring or denying his or her biases. Uh-oh. Are professional investors missing out by ignoring a sea of bias and emotions that could lead to bad decisions? Fortunately, we can lean on insights from intelligent people across different fields who have been trying to answer this question for decades. Benjamin Graham, the original value investor, supported the idea of behavioral economics when he recommended unpopular and less expensive stocks over fashionable or high-valuation investments. Famed economist John Maynard Keynes, whose ideas may have helped the United States emerge from the Great Depression, also tried to save individuals from making bad economic decisions. Animal spirits. The market can stay irrational longer than you can stay solvent. John Maynard Keynes. Keynes realized that individual investors can make irrational decisions, and that at a macro level, these decisions can move markets in financially painful ways. If a thundering herd of bad decisions creates wild moves in markets, perhaps individual investors are acting on more primal emotions rather than using human logic and intellect. Keynes coined the term animal spirits, referring to gut feelings, emotions, or whimsical changes in consumer and investor attitudes that can play an important role in investment decisions. Robert Shiller, another behavioral economist and Nobel Prize winner, refers to animal spirits as a sense of optimism and ready energy to be entrepreneurial and take risks. Turn on a business news channel sometime and you'll hear plenty of chatter about animal spirits when markets become choppy and investors careen from agony to ecstasy, or vice versa. But is animal spirits just a catchy term used to sell cable airtime, or is there something to it? If animal spirits go to extremes, investors should take notice, following Keynes's earlier quote. Shiller also notes that high animal spirits in the stock market are often associated with the disparagement of traditional authority and expert opinion. When we get excited, we often go with our gut rather than seeking external resources as we make decisions. Is there a disconnect between dreams and expertise in the stock market as Shiller proposes? If this is true, perhaps we should focus a bit more on how changes in attitudes can change our financial well-being. If emotions or feelings influence a lifetime of financial decisions, we can end up with a much lower quality of life than we intended. However, investors can fight back against these visceral feelings and emotional urges to simply trust your gut. We can make better decisions if we look for warning signs that tell us we are about to make a big mistake. Perhaps we can lean on the expertise of Nobel Prize winners to prevent our dreams from becoming financial disappointments. Another behavioral economist and Nobel laureate, Richard Thaler, has a great sense of humor and plenty of good advice for financial decision makers. Thaler had a cameo role alongside pop star Selena Gomez in the 2015 movie The Big Short, in which he explains in plain English the mental shortcuts and biases that fueled the housing bubble. In the movie, Thaler refers to the hot hand fallacy, in which sports fans overestimate the chances that a basketball player on a hot streak will hit the next shot. Many investors during the housing bubble felt that home prices were on a hot streak, and that the next move would be up. Does this seem logical? Thaler knocks that idea down like a house of cards in The Big Short by suggesting that we rarely act logically. The rise and fall of asset prices during the housing bubble suggests that plenty of humans glossed over logic as they made investment decisions. Speaking of asset bubbles, history suggests that these major imbalances occur every few years. And perhaps paying closer attention to our biases and emotions can help us avoid falling into a major financial calamity like the housing bubble. Thaler may provide some assistance here because when he takes time away from his Hollywood career, he advises people to pay very close attention to decisions that are difficult, rare, and risky. Asset bubbles check all three of these boxes, suggesting that investors should be on high alert when stocks or other commodities start melting up. Aside from asset bubbles, my sense is that financial professionals who look at stocks on a daily basis could benefit from Thaler's warning signs. In my experience, every stock is a different situation, suggesting that full-time investing can have difficult, rare, and risky moments. When professional investors sell a stock that they've owned for years, they are making a difficult and risky decision on a stock that they've rarely traded. While this book takes a systematic approach to handling these types of investment decisions, Thaler's basic recommendation is that you need to slow down, pay attention, and be reflective. Investors can make better decisions in areas where they have experience, good information, and prompt feedback. I wish that it was this easy. Unfortunately, on the long-term investment journey, we can encounter lots of emotional twists and turns before reaching a final destination. Here's one way to look at it. Investing requires us to make difficult decisions, but emotions and biases can lead us to bad decisions. Fortunately, smart Nobel laureates have created tools to help people make better economic choices. However, this solution has its own problem for investors. How do you know which concept to use at what time? Because there are so many. This book compiles a comprehensive list of these tools as a guide for making better financial decisions throughout the ups and downs of our investing experience. Think of this book as an instruction manual for a toolbox that contains more than 100 different hammers, drills, saws, and screwdrivers. In this case, however, rather than building a house, we're trying to build long-term investment performance. In a way, listening to this book is like working with a trainer or coach to help nudge us in the right direction as we make financial decisions. We don't have to unlearn or unfreeze the way we've always invested. In contrast, we can add some new tools to help put a few more points on the board as we try to improve performance and avoid costly mistakes. This book breaks down the investment process into foundational building blocks and takes a behavioral coaching approach. The book's framework helps investors identify emotions and biases while also creating strategies for improving performance for each step of the investment process. The term behavioral coaching has a fairly loose definition across the field of sports, training athletes, business, managing employees, and psychology. However, for this book, I use the term to refer to a process of applying concepts from economics and psychology to nudge people into making better decisions. By taking a step-by-step approach to researching, buying, trading, and selling stocks, we can turn to our virtual trainer each step of the way. Just as a real trainer will recommend a specific exercise for building your biceps, this book offers specific behavioral coaching tips for each step in the investment process. Perhaps, if we use a behavioral coaching framework and think about money in a different way, we can reduce emotional volatility and feel more secure about our future. 100 Steps to Better Investment Decisions. In 2015, a former employer encouraged me to read Daniel Kahneman's Thinking Fast and Slow and be prepared to discuss it at an internal conference. Thinking Fast and Slow gives the origin story of behavioral economics and describes dozens of situations where emotions and feelings cloud our financial decisions. I left my employer before the conference, but I decided to read the book anyway, and in fact, I read it twice. As a professional investor, I kept saying to myself, wow, these are great tools. I should try to use these to help improve my stock picking process. Before I knew it, I had taken dozens of notes. But what was the best way to use the Kahneman toolbox to pick better stocks? At first, I summarized the Thinking Fast and Slow tools and pinned the summary to my wall. But sadly, that turned into wallpaper. The ambitious planner in me turned into the lazy doer as I unsuccessfully tried to change my investment process. I also tried to incorporate some of the tools during weekly investment meetings, but this felt like a disorganized and haphazard approach. During this trial and error process, I came across another treasure trove of behavioral economics tools in Richard Thaler's books, Nudge and Misbehaving. As I was collecting behavioral investing tips, my interest and excitement took off in 2017, when Richard Thaler won the Nobel Prize for Economics. Susan Fulton, who co-founded my firm, met Richard Thaler during a class, and she highly recommended incorporating Thaler's ideas into the investment process. With this renewed energy, I gathered scores of other ideas from Thaler as my newly expanded toolbox approached 100 tips for better investment decisions. Thaler's behavioral research spans fields from finance to politics to sports. In football, Thaler found that many NFL owners overpay for a first-round draft pick, even when data suggest that the top draft pick is expensive. Thaler's work suggests that owners can get more bang for their buck by paying less for a later draft pick. In describing a pattern of overconfidence and overpaying for draft picks, Thaler says, "The stupidity continues." In contrast to what NFL owners often do with draft picks, the point of this book is to use behavioral finance concepts and data to stop, think, and make better investment decisions. While most of the concepts in this book come from Nobel Prize-winning economists, I've also incorporated a few behavioral coaching tips that I've picked up during my 20-year investment career that come from experience, or from authors other than Kahneman and Thaler. As these tips began to accumulate, I wasn't sure how best to translate this raw material into a finished product that would help me, or anybody else, make better financial decisions. I Googled around to see if anyone else had organized this long list of behavioral economics themes into a guide for investors, but nothing really fit the bill. Most of the research I found in the area went deep into a short list of widely known behavioral finance tools. But what about the other 80 or 90 concepts? I started to feel sorry for the forgotten tools in the Kahneman and Thaler toolbox, so I decided to create some kind of guidebook or instruction manual that includes all the ideas in an easy-to-use format for investors. But where to begin? After some deep thinking, 2 light bulbs popped in my head. First, I needed to organize the 100 Kahneman and Thaler concepts into a user-friendly format, so that investors could quickly find the right behavioral coaching tip at the right time. And second, I needed to apply each of the theoretical tools to the real world of investing. By way of background, Most of the Kahneman and Thaler ideas cover a broad range of economic decisions, such as buying a house, taking a job, or shopping at a grocery store. The field of behavioral economics tries to identify recurring flaws in our decision-making processes, such as recency bias, only focusing on recent events rather than all events. Once we identify these flaws, Kahneman and Thaler give us recommendations for leaping over these pitfalls and getting to better decisions. Before getting deeper into the world of behavioral finance, I need to give credit to Amos Tversky, the third giant in the field who worked closely with Daniel Kahneman. Tversky probably would have shared a Nobel Prize with Kahneman had he lived a few years longer. In 1974, Tversky and Kahneman began establishing a behavioral approach to economics and finance that says that a variety of biases, such as overconfidence, loss aversion, and anchoring, limit individuals from making totally rational choices. In this book, every time I refer to Daniel Kahneman, I implicitly also refer to Tversky's extensive contribution to the field. As I learned more about these innovators in the field of behavioral finance, I began to see challenges and opportunities. On the one hand, these Nobel laureates revolutionized the understanding of our brain's shortcomings. Additionally, Kahneman and Thaler identified ways that we can overcome some of these problems, thereby improving decision-making and our investment process and results. On the other hand, how could I take the broad body of knowledge from these experts and apply it to a specific part of the economy, the investment world? My solution was to take about 100 of the Kahneman and Thaler recommendations and divide them into 12 smaller groups that correspond with each step in the investment process. Why 12 groups? In keeping with a goal of full disclosure, I used my judgment in allocating these 100 behavioral coaching tips across the 12 parts of the stock-picking process. As my colleague Zach Weiss once told me, the decision to break up the 100 bias warning signs into 12 smaller parts is itself a shortcut or form of bias. Yes, even people writing about the dangers of behavioral bias can make mistakes that they tell others to avoid. To be sure, there are many behavioral theories that could help several parts of the investment process. For example, in Chapter 1, we talk about confidence bias, where confident speakers or experts can have an outsized influence on investment decisions. Using my taxonomy, we look at defeating confidence bias early in the investment process because investors may be starting from scratch and highly influenced by new information from outside experts. However, you could justly argue that investors should be cautious of overly confident people and sources across the entire investment process. This means keeping an eye out for confidence bias throughout the initial research screening process, during heated debates with investment committees, and even while watching a TV commentator discussing a stock that's way up or way down after you've bought it. Another way to think about organizing the 100 tools is a knowledge framework called Bloom's taxonomy, which follows the progression of basic knowledge as it transforms into applications, evaluation, and creation of new ideas. In a similar way, the 100 tools in this book start out with basic stock research, advancing to an investment thesis, and finally reaching a pinnacle for judging a buy or a sell. The book's table of contents is a good starting point for visualizing which behavioral coaching tip we need during each step of the investment process. Now that I've described the fairly messy process of allocating the 100 behavioral coaching tips, I next try to bring some order to the chaos by providing real-world examples that connect theory to practice. Because many of the Kahneman and Thaler tools can seem a bit abstract, this book gives clear examples of how investors can apply these broader economic theories to financial analysis and portfolio management. This book is the final product of these efforts, and I hope that investors, financial advisors, and savers will benefit from a new way of looking at the body of work that Kahneman and Thaler created. In the spirit of transparency, this book starts with the premise that Nobel Prize winners in behavioral economics can help our investment process and potentially improve our returns by lowering the emotional cost of investing. Research suggests the behavioral mistakes can cost portfolios nearly 1.5% in annual performance, as described later, and over time, this can erode long-term savings. Additionally, we discuss in Chapter 1 the idea of the behavioral edge as a way of attempting to outperform the broader market. As the behavioral finance field evolves, we may start to see more hard data supporting the idea that Thaler and Kahneman's concepts can help us improve performance. But in the meantime, my experience suggests that investors continue to make costly emotional mistakes. My bottom line is that any help in identifying and correcting these mistakes should benefit performance. Can computers save us from our emotions? According to Kahneman, we trust our intuitions even when they're wrong. If we simply rely on our own intuition for investment and retirement planning, a lot could go wrong. So, what's the best way to apply the wisdom of Nobel laureates to day-to-day financial decisions? The good news is that many of these tools are common sense and easy to understand. The bad news is that the human brain is probably, make that definitely, unable to remember or process these 100 behavioral coaching tools when we need them most. This brings up an interesting point. Maybe human brains have no business trying to pick stocks or save for retirement on our own because we're unable to multitask the way computers can. Should we turn our financial futures over to robo-advisors or low-cost, passive investment vehicles as a way to avoid the perils of emotional investing? As a professional investor, I'm biased to say, of course not, because my livelihood stems from a fundamental stock-picking process. However, investors fall across a diverse spectrum, including those in the early part of their asset-gathering phase. Many of these investors and savers can do well with simple, automated investment tools that can reduce the emotional cost of investing. Still, as many of us blossom into more complex families with diverse assets, for example, stocks, bonds, funds, real estate, etc., and liabilities, for example, mortgages, college tuition, weddings, healthcare, etc., the human touch becomes increasingly important. In fact, I would argue that we can get ourselves into more trouble by trusting computers to plan our retirement, because we have more complex financial lives. This is because we as humans need to tell the computers what to do. A robo-advisor might recommend rebalancing or buying stocks when markets are crashing, but will we pull the trigger and tell the computer to buy? The field of behavioral economics would say probably not. Exhibit A is Thaler's recommendation to be very careful when making financial decisions that are rare, risky, complex, and have limited opportunity for feedback. If we buy high or sell low, even using low-cost investment tools, we can get ourselves into financial quicksand. If this is the case, then most investors should benefit from a greater awareness of how emotions and feelings influence our financial decisions. Have fun and get better at investing. As a father of 5 kids, I've had the pleasure of coaching several youth sports programs, and I've generally encouraged most of my players to have fun and get better. By keeping it simple, I've hopefully led some of the kids to focus more on foundational skills, having a good time, and enjoying the process of developing, rather than obsessing about the scoreboard. So, what do youth sports have to do with investing? In a sense, both activities rely on practice and decision-making. Practice is a definite for sports, and I have high conviction that repetition and experience are crucial for investing. Malcolm Gladwell's book, Outliers, suggests that if you want to get serious, you need to put in 10,000 hours to get really good at something. If you are a professional investor working 40-plus hours a week, it might take you 5 years to accumulate 10,000 hours of experience. And during those 5 years, what kind of decisions are you making? Are you getting better, worse, or perhaps stagnating? Often we make bad decisions, either in sports or in investing, because we are in a rush, or we take shortcuts rather than taking the time to weigh the pros and cons of a decision. You might argue that decision-making is totally different in sports relative to investing, because athletes have to make split-second decisions on the field or on the court that determine wins and losses. However, in some ways,
Sample complete. Ready to continue?